How's everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So today's episode, we're going to be taking a look at yield. So, it's specifically around United States Treasuries. So a lot of people love Treasuries because they provide income and they provide a lot of safety. But the question now is, with interest rates set to decrease, are there some other alternatives out there from U.S. Treasuries? And so today we're going to take a look at two articles from the Wall Street Journal. One of them offering three potential alternatives to U.S. Treasuries in case you're searching for yield as interest rates decrease. But then also, we're going to ask an interesting question. What is better? Is it, a tax-exempt municipal bond or a taxable bond? So we're going to take a look at that too as well. So let's jump into the first article here. Three alternatives to U.S. Treasuries that give you safety and yield. Munis, agency mortgage-backed bonds, and preferred stock are worth considering, financial pros say. So, U.S. Treasuries remain the go-to investment for people seeking income and safety. Nevertheless, financial professionals say there are other corners of the fixed income market investors should consider that offer greater yields and are still relatively safe. The current level of prevailing yields is attractive, both outright and certainly relative to the compensation that bonds have offered for much of the past couple of decades, says Roger Hallam, global head of rates at Vanguard, adding that bond yields are much higher than they were a few years ago and therefore more enticing. The 10-year U.S. Treasury note, for example, is yielding 4.329. It's actually dropped a little bit since then. It's actually down to more of 1, 2, 3, something like that. But anyway, here are three areas that experts like for more income with minimal risk. Number one, municipal bonds. Munis have lagged behind the broader bond market this year. The S&P Municipal Bond Index is about flat through August 19th, trailing the 4.5% return for the Bloomberg U.S. Aggregate Bond Index. AAA-rated munis with 10-year maturities are yielding about 3.2%, according to FactSet. But it's important to keep in mind that the interest that munis throw off is exempt from federal taxes and sometimes state and local taxes as well. So using a hypothetical example of a 37% marginal federal tax rate, that 3.2% yield would be around 5% on a tax equivalent yield basis, excluding any exemptions for state and local levies, topping the 10-year Treasury yield of around, again, like I said, 4.1%. What's more, Dan Close, head of municipals at Nuveen, notes that overall credit quality for munis remains very strong. You have collections that are at record highs for property taxes, income taxes, and sales taxes, which are the big three revenue sources for municipalities, says Close. The second one to consider is agency mortgage-backed securities. These bonds issued by quasi-government bodies like Fannie Mae and Freddie Mac are effectively backed by the U.S. government, making them almost as safe as Treasuries, as most investors don't believe the government will let them fail. As of August 17th, agency mortgage-backed securities with an average maturity of about 8 years were yielding just under 5%. Above both 10-year Treasuries and comparable investment-grade corporate debt, according to Bloomberg data. You're getting the same sort of yield that you would get from corporates, but with less interest rate risk, says Lawrence Gillum, chief fixed income strategist at LPL Financial. A long-term consideration for this part of the market is the possibility of an eventual privatization of Fannie Mae and Freddie Mac. Without the backing of the federal government, these mortgages would require higher yields to attract investors, but for now, agency mortgage-backed securities look like a relatively safe haven. And then number three, preferred stock. So while preferred stock isn't as safe as government-backed bonds like agency debt, these securities outrank common shares in a company's capital structure. So if there's ever a bankruptcy, the preferred shareholders would be ahead of the common holders. But there's plenty to like about preferred long before a bankruptcy ever occurs. They provide high tax advantage income, and that income is coming from generally high-quality issuers, says Elaine Zaharis-Nikas, a senior portfolio manager and head of fixed income and preferred securities at Cohen & Steers. The bulk of the issuers are banks and insurers, industries with solid fundamentals. Investment-grade preferred are yielding in the neighborhood of 6% to 6.5%, very attractive. Additionally, she says the income paid by preferreds is treated as qualified dividend income in many instances. That means that it's taxed at up to 20% depending on an investor's marginal tax rate, a more generous treatment than ordinary income receives. Preferred stocks are divided into two segments. $25 par holdings, which target individual investors and trade on exchanges, and $1,000 par holdings, which trade over the counter and target institutional investors. Ways for individual investors to access these holdings include mutual funds. It's more common in the $25 par universe to see fixed interest payments either in perpetuity or over a specified time period. In the over-the-counter market, there are plenty of holdings whose yields reset. As of August 15th, the ICE BOA index tracking the $25 par market had returned 2.5% this year, yielding 6.25% according to Nuveen. That trailed the 5.3% gain for an index tracking the $1,000 par preferred market with a yield of 6.02. Okay, so again, just to recap that. So what are our three options there if you don't want to do treasuries? You have number one, municipal bonds. Number two, agency mortgage-backed securities. And number three, preferred stock. All could be potential great investments in their own right, depending on what's going on in the overall market. But now let's ask a question. So say you want to do municipal bonds. Then the real question becomes, well, okay, well, what's better, a tax-exempt municipal bond or a taxable bond? Does it make sense for me to go one way or the other? So let's take a look at this article here called Tax-Exempt Munis versus Taxable Bonds, which has a higher return. And there is a clear winner for most people, according to the research. So many investors turn to tax-exempt municipal bonds to avoid paying federal and possibly local taxes, sacrificing a bit of yield in the hopes of having a higher after-tax return. But is this better than investing in taxable bonds and paying taxes on income distributions and capital gains? Exploring all muni funds in the U.S. over the past 15 years and comparing them with other comparable taxable bond funds, we find that most investors are, in fact, better off going with munis. Only in cases where an investor has a low marginal tax rate below 30% and is interested in short-term debt does it make sense to invest in taxable funds. To study this issue, my research assistant, and I'm going to skip that, and I pulled data on all muni funds in the U.S. We then organized them by their state of concentration, average maturity, and expense ratio. For the comparison group, we pulled data on all taxable bond funds, funds focused on taxable debt like corporate or treasuries, and did an equivalent sorting. To compare apples to apples, we focused on three categories of funds across two fund groups: a general index fund that invested in all types of debt, short-term debt, and intermediate term debt. We match tax-exempt and taxable funds by their fees, credit ratings, and average maturity to ensure a like-for-like comparison on a risk-adjusted basis. So, and here is a breakdown of performance in the three categories. So first, when we compare the average general muni fund against the average general taxable bond fund, the return profile on the muni fund looks better. Over the past 15 years, the average muni bond fund has delivered a post-tax annualized return of 3.32%, while the comparable taxable bond fund has delivered a post-tax annualized return of 1.54%. Now let's jump down here. So when we explore intermediate term muni debt to intermediate term taxable funds, we find a similar result. Investors across all tax rates have been better off investing in intermediate term munis. Over the past 15 years, the average intermediate term muni fund has delivered a post-tax annualized return of 2.53%, while the comparable taxable bond fund has delivered a post-tax annualized return of 1.72%. The risk of the two funds has been similar, with the intermediate term fund demonstrating a rolling 5-year volatility of 5.14%, and the intermediate term taxable fund demonstrating a rolling 5-year volatility of 6.28%. And then when we compared short-term municipal debt with short-term taxable funds, we found that the average short-term muni fund delivered an annualized post-tax return of 1.32% over the past 15 years, while the average short-term taxable fund delivered an annualized post-tax return of 1.25% over the same period. Volatility of the two funds were similar at 2.24% for the average short-term muni fund and 2.35% for the average short-term taxable fund. When we adjust the tax rate assumption, however, we find that investors in the 32% marginal tax rate bracket would see roughly equal returns in muni funds as in short-term taxable funds on an after-tax basis. Therefore, if you are below the 32% marginal tax rate level, then it is usually better to invest in a taxable bond fund and pay the taxes. We should be clear that each person's tax situation is different, and we are comparing muni funds at an aggregated level. Each state-specified fund may offer different returns based on county-specific projects and opportunities. Further, it is always important to compare current yields of these funds so you can have an expectation of what you will be earning in the future. So again, I thought these were very interesting, very interesting articles here. So as we prepare for a decreasing interest rate environment, it's important to know what other options do we have out there. And this goes for, a lot of bankers out there that, you're managing the bank's investment portfolio, trying to figure out, well, what should we invest in? Obviously, the government would love you to buy a lot of treasuries, but it may not always make sense to have all your eggs in one basket, have all your eggs just simply in treasuries. You might want to look at some of these other investments out there, as well as the same for individual investors. If you find that CD rates are dropping and you want to go in search of maybe some other yield, these could potentially be some other really good investments for you to consider. And I always put out the disclaimer there that, again, I am not a financial advisor, so I would highly recommend you seek out a financial advisor and talk to them about, comparing these different potential investments and determine what would be the best thing for you as well. I would also advise maybe speaking with your accountant as well. I think that would be a good idea as well when considering some of these different investments as well. So with that being said, I hope you enjoyed this episode. Please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. I hope you have a great day out there, and I will see you again real soon. Thanks a lot.